Welcome to section 8, and in this section I want to actually compare the structure of the stock market with the structure of Forex. Since I'm sure you were familiar with the stock market before Forex, a lot of people, when they hear trading, they think the stock market. So we're going to compare the stock market and Forex a little bit in this section. The stock market is what is called a centralized market, and this is how the structure of the stock market looks. The stock market only has one specialist that controls prices. All trades must go through this specialist, and because it is set up this way, price is easily changed to benefit the specialist and not the traders. You may be thinking, what? How does that happen? Well, in the stock market, the specialist is forced to fulfill the order of its clients. But let's say all of a sudden there are a lot more sellers than buyers. Since the specialist has to fulfill these orders, the traders would win and the specialist would be left with a bunch of stock that he can't sell off to the buyer side. Well, what the specialist does is increase the spread or transaction costs like crazy so that no sellers would dare to enter the market. So the specialist can and does completely manipulate the market to accommodate its needs so that the specialist wins and the traders lose. Doesn't really sound like a formula for success, does it? On the other hand, Forex is decentralized. Unlike the stock market or trading futures, you don't need to go through a centralized exchange like the New York Stock Exchange with just one price. The Forex market is decentralized and there's no single price for a given currency at any time, which means quotes from different currency dealers vary. And this is what makes Forex so amazing. There is so much competition between dealers, so you get the best deal almost every time. So now let's talk about the participants in the Forex market and let's organize them into a ladder. At the very top of the Forex ladder is the interbank market. This is composed of the largest banks in the world, and they are constantly battling for clients and trying to one-up each other for market share. Next on the ladder are the hedge funds, corporations, retail market makers, and retail ECNs. Since these institutions do not have tight credit relationships with the participants of the interbank market, they have to do their transactions via commercial banks. This means that their rates are slightly higher and more expensive than those who are part of the interbank market. Then at the very bottom of the ladder are the retail traders, you and me. It used to be very hard for us traders to participate in the market, but now it is easier than ever before and we are able to trade with those higher up in the ladder. So now that you understand the structure, let's talk about who everyone is that participates in the Forex market. What happened is until the late 1990s, only the big banks could play this game or people who had 10 to 50 million bucks to start, which is probably none of you that are watching this video right now. But once the internet came out, online Forex brokers made it possible for us to trade with much smaller amounts. These are the major Forex players. The first are the super banks. Since the Forex market is decentralized, like we talked about, it is the largest banks in the world that determine the exchange rates. These large banks are known as the interbank market, and they take on trillions of dollars a day in Forex transactions for both their customers and themselves. A couple of these super banks include Citi, JP Morgan, UBS, Barclays, etc. The second major player in Forex is large commercial companies. Companies take part in the foreign exchange market for the purpose of doing business. So just take, for example, Apple. Apple, to be able to buy electronic parts from Japan to make their products, they have to first exchange their US dollars for the Japanese yen. The volume that companies trade is much smaller than those in the interbank market. But when one company acquires another cross-border, that can also move the market quite a bit. Finally, the last major player is governments and central banks. Governments and central banks, such as the European Central Bank, the Bank of England, and the Federal Reserve, are regularly involved in the Forex market too. Just like companies, national governments participate in the Forex market for their operations, international trade payments, and handling their foreign exchange reserves. So these are the major players in the Forex market, and I hope you've seen a little bit of the difference between the structure of the stock market and the foreign exchange market, and how the foreign exchange market is such a great opportunity for you to participate in. In the next section, we're going to talk a little bit more about the difference between Forex and stocks and the benefits of Forex over stocks. So we'll see you in that next section.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.